Hello, folks. Brandon Chapman with you today. It's a Theo Night Monday video. Man, it's a lot's going on this past week. You know, some stuff we addressed last week, kind of playing out in the market. Certainly today was not necessarily the most bullish day. We did fade from the highs. And as we look at the sector leadership, energy shined as the luster of tech is tarnished. So we can see the bookends of energy and technology. Technology really significantly underperforming today. And so if you're really trying to build the bull case, man, seeing utilities and energy at the top probably is not there. But we're going to look at, is there a bull case to be made? What levels are significant and some stocks that could be interesting to watch this week for opportunities. Anyway, so as we look at the ES, you'll notice that we're making a pullback, right? So back on the 12th, you know, a lot of the volatility indicators were suggesting that we're looking at a near-term pullback of probably 5 to 10%. Normally that happens, you know, within 2 to 3 weeks. And so that's what we're in the midst of right now. So you look at it from high to low. The low today, oops, wrong one. I got to bring up the line drawing. So click here, go down to here. We're down about 7.5%. And when you look at what happened on the 12th, it was significant. Number one, skew increased. You'll notice we ran up here and touched very close to 130, which is an extreme level, shows a high degree of hedging. And that happened as we saw a nice surge in the market. If you look at the VIX on the 12th was down here, for example, right? The VIX was the lowest level it had been in months. And then you look at front to back month volatility, or back to front month volatility, or the forward premium, 3 month against 1 month VIX. And I'm going to bring up something called a pairs ratio, which plots a ratio of the 3 month to the 1 month VIX. And what ended up happening up here, and I'm struggling drawing anything, what ended up happening over here in the yellow line, what you'll notice is, man, there we go. What you'll notice is we pegged the 1.2 level, which means what? The 3 month VIX was 20% higher than the 1 month VIX. That's a significant threshold where the market's pricing in substantial volatility in the coming weeks. And so we put those signals together, and on the 12th said, look, we're looking at a 5 to 10% pullback in the market. And that's kind of where we're at right now. We're just in the midst of the pullback. And of course, the next question is, are we there yet, right? So the are we there at that yet scenario suggests, are we going to form a low, right? Are we nearing a low point in the market? So we start to draw our fibs the other direction. So if I come down here, bring up my fib, my drawing tools, click on the low, go to the high, you'll see we're approaching about a 50% retracement. Normally, that'd be pretty significant area. Notice how in the ES, we hit the 61% to the upside. So now we're pulling back to the 50% correction of this uptrend. Look at the strength of the initial sell-off right here. What does this suggest? Could we end up at a full retracement at 3,700? That's where your 261 is. Your 161 to 138 is right where we are right now. So are we in an area that we could see a bounce? Absolutely. The question is the market pricing that in? Going back to the volatility indicators, we're not going to get skew until later today. But one of the more alarming things that happened on Friday in that significant sell-off is that skew increased. You don't generally see that, right? Normally skew should go down instead of went up. What it displayed is that, you know, institutions were hedging, buying puts and selling calls on Friday rather than just liquidating stock and buying puts to quickly stop the bleeding. That's not what we saw on Friday. We saw hedges being put on systematically, not in a panic, right? People say, well, the VIX is a fear index. Well, I guess maybe so. We didn't see fear on Friday. We saw, you know, some hedging. We saw increased demand, but we also saw that the volatility became more skewed, meaning that the out of the money call volatility relative to the out of the money put implied volatility became even more skewed towards the puts. And again, that's not the bullish sign you're hoping for when the market's down a couple percent, as it was on Friday. So now as we move in today, well, if we look at the same volatility indicators just from a different perspective, the 3 month VIX should be trading below the spot VIX. What you're seeing right now, 1.02. We're still about 2% higher in the 3 month VIX than the 1 month VIX. Would love to see this get down here below 1. Another angle to look at this is by going to product depth here and looking at the VIX volatility futures. Two things to look at. Number one, look at these two contracts right here. Take the average of them. We're looking around what, 26.6, 21, 26.7. Where's the VIX today? 26.2. So what do we see? The VIX futures are still pricing at a premium to the spot VIX. We want to see it below the spot VIX to provide that expectation that volatility is going to fall in the near future. The second point to make here, we want to see that the VIX in backwardation, meaning that this contract is higher than that contract, which is higher than that contract. We want to see a line that looks like this, not like this, like we're currently seeing. But you look at the range here. I mean, the range is pretty level, right? We're pretty flat. We're just going to need maybe another bigger down day to push us over into that more bullish scenario. Even if you look at the volatility, the VIX today finished at around 26, but yet when you apply some volatility bands like the Keltner, 20-day Keltner, so it's 20-day exponential 2 ATR, you'll notice we finished at the upper band, right? We touched the upper band last week on Monday and then on Friday. Today we also went above it but finished below it. We're not seeing the big surge to say the volatility is really expanding, which goes back to the skew increase we saw on Friday, right? There was an offset by selling the calls that caused so the VIX did not have as much mobility and as big of a pop to the upside. So what does this mean for the market? I use this term quite a bit, but what it shows is that institutions, for the most part, are delta comfortable, right? They've been incrementally hedging, not excessively selling necessarily. You know, certainly you look at today, for example, the baby's not going out with the bathwater. His energy is 1.5% higher. And so they're kind of comfortable. They've been repositioning themselves in the market. And you look at the performance in the last, for example, 1 week, you'll notice technology is down 4.1%, the worst performing sector. Energy is the best performing sector. Last 6 weeks, energy is up 19%, right? The worst performing sector in this list is what? Healthcare and communications. So again, you can see where the money's been pushing towards. And in the last 12 weeks here, 6 weeks in particular, it's been utilities. It's been energy. Staples are kind of in the mix here. Not a great performer, but not a terrible performer. Industrials have done okay in the last 6 weeks, for example. So what you're seeing is there's rotation happening right now, and it's rotating away from, right? In the last little over a week here, it's rotating away from technology. We saw the surge or the move towards technology as the market was running higher back here because of the short squeeze. What we're seeing now is we're seeing rotation away from it and into some of these other sectors. And so, man, having trouble with the mouse here. But again, it's just really important to kind of understand where we are at the moment. And where we're at is in a very bearish environment, not really reaching that capitulative point where you really expect the market to rally strongly. Similar to when we got back on June 13th, right? The market breadth was awful. Volatility, if we bring up the VIX, for example, it was up. The 3-month VIX was above the 1-month VIX. VIX was in backwardation. Lots of things signaling this is a very strong level of support. Now, what I'll say with regards to that is that it doesn't mean that the market can't move higher a little bit, right? But we saw here it went up for a couple of days and then ripped lower. The resistance right now is about 411, right? 4100, 4111-ish on the SPX or the whatever you're looking at. So the idea is that maybe we catch a little bit here, but again, the risk right now with the rising skew is to the downside, okay? So we can't just completely ignore that possibility that we could continue selling off here. But again, right now we're poised. Some of the news out of Iraq, just the general news in terms of oil inventories decreasing, Saudi Arabia talking about, the possibility of cutting production, OPEC plus seeing relatively conjoined or together in to be able to manipulate oil prices. Because why? Supplies are down. The strategic oil petroleum reserve is way, way down historically. They know they got us where they want us, and it's going to allow some solidarity to form. And as long as the demand just doesn't fall off the cliff, it's hard to imagine that oil prices are going to slump dramatically. Look at the product depth for oil prices, for example. Notice what's happened here in just recently. Again, these are kind of going back a few weeks here. Notice how the curve is steepened, right? The backwardation has become steeper, which is also more bullish for oil. What that means is the falling prices suggest that there is a what? That there's a net positive cost of carry, that the cost of finance and store oil is not as high as what you can lease it out at. And so we're seeing falling prices out here. This is a bullish situation. And so we have to look at oil. Yeah, we meandered down over a couple of months, but the risks right now are still to the upside. And we've seen these rallies can be very, very fierce when they want. And so again, we're seeing rotation now for the second week in a row to start kick things off this week into energy. In fact, one of the stocks last Friday we talked about as having bullish option activity last Monday, rather, back here was MRO. Okay. And so again, energy continues to be fairly strong. Today, you saw there was some activity in Apache, or rather APA Corporation. Again, it's had a very nice week, a breakout. We might be nearing some short-term resistance. So, look for this thing to maybe pull back. But the realities of right now is we could see this continue to push towards 45.23, or we draw our fibs. Notice that we start to break 44, break our highs here. We're looking for this to go back to 50-ish. Now, today, the option activity in Apache, this was for an October expiration, so it's out there a little bit. But it was an upside call spread that was rolled up. So we had the 40, 45, got rolled up to 42.50, 47.50. So my point in sharing this is saying, look, there's some profit taking, but we're kind of extending the reach of that vertical out to 47.50. That's up here, right? That's back towards prior highs. So again, looking for this to continue to move. Near term, I guess it could potentially pull back. Petrobras, right? This is one that last week, we saw bullish activity in EWZ, and this is one we were looking at way back here in this rally. This is kind of nearing some resistance, but this was a weekly here at $15.50. We touched 15.5 and we backed off of it. So, energy right now is kind of holding the market, the glue that's holding the market together. It's relatively extended in the near term. Doesn't mean we can't continue to push, but you might have to need a little bit of a pullback for some of these stocks to kind of hop in here to make it work. Halliburton today as well. Halliburton on this December expiration out here. So again, what we had was, kind of a roll going on, right? So the idea is a lot of this stuff, we're rolling it out to higher strike prices, taking profits in energy, which why wouldn't you? We're in a bearish market environment. The risk is to the downside. Right now, oil's holding up. So again, watch Halliburton. Do we start to take out the highs over the last couple of days? You start to look at this as a potential seed wave, and you're like, could we get to 36? Absolutely. But oil's got to continue and remain strong. That's about your 50% retracement. So watch. Again, if we start to see some breakouts tomorrow above recent highs, we may have a chance to continue to move here. Now, on the energy front, things like CCJ, this is one that I reviewed option activity on last week during my session. There was even activity came in here in CCJ, looked like ring to the upside. We paused for a couple days and boom, we broke out today. And for CCJ, again, we're looking at the kind of shorter dated stuff to really kind of squeeze the stock higher. 42,000 contracts traded at 31. Again, some bought, some sold, mostly bought. But again, we're looking for 31. We're looking to get back to prior highs here. So again, you can try to ride the wave, but the bullishness in uranium, again, URA, UEC, it's happening across the board. UUU, and all these companies. Japan last week came out and said they may start to go back to nuclear. Makes sense if you're gonna electrify everything using batteries. One that we kind of looked at last week as well was Kano. This is one, again, it reached kind of that target area we talked about. You're probably looking to take this thing off. Could it keep running? Yes. Are the fundamentals great? No. So again, this was a swing trade, kind of reached the target from where we were last week. KRE. This was, banking financials was one of the poor performers today. KRE finished at lows. This is one that last week we talked about the out of the money long put vertical with a lower strike price of 57 for 30 September. It was a 64 57. Again, I think this is very reasonable. We may continue to see downside here. And part of the picture comes down to what? Treasury yields. Treasury yields, despite the market was down a little bit, yields were higher. 10-year at 0.75. TYX was only at 0.42. FVX was up 0.68. So what does this tell you here? Right? The curve is flattening at the moment, right? We're not seeing the long end of the curve of the 30-year sell off out there, right? We saw that on Friday as well. And so again, as the Fed is expected to raise rates aggressively, we're going to see a further flattening and inversion of the curve. And again, that puts pressure on banks. The spread between short and long is basically becoming flat to negative. And so as you think about KRE, again, kind of breaking out on Friday, continuing down today. And you could parlay that into XLF as well. XLF last Monday, we're looking at downside spreads towards 31.50 here. So expecting to see these moves continue along with bearishness in IYR as an example. Again, that was one we saw 98, 96 a weekly. Finally got to 96 on today. But again, we're seeing just continued bearish interest. There was a couple of bearish trades on IYR last week. So again, we're looking at continued expected downside in real estate, financials, bullishness. Again, to the extent that the market everyone just doesn't panic sell everything. We're looking for bullishness in energy and a couple of those stocks to consider. These were some of the top performers today. And so rather than getting in, we're normally looking at RIG and AR, we're looking at Oxy, those kinds of names, MRO. There's a lot of times some option activity in those names. This case, it's a bit different. This is Northern Europe Oil. It's a royalty company breaking out today. Volume ended up being moderately high. This company pays a dividend. I don't know how consistent it is, but this is not a dividend long-term investing trade. This is a short-term investing trade looking for the price to get back to prior highs at around 20. That gives you over 10% upside in the near term. And so again, it seems like a pretty reasonable trade. They don't have any risk on the production side of it. They just make money off of the production that's being done. They don't have to worry about cost overruns. They just get a percentage. And so these companies are interesting for that purpose. Again, looking at $20 being the upside. Another one that's a little smaller. This actually, their production's in South America. It did fade a little bit today. Let me just clear my drawing set here. It did fade from the high to some degree. In this case, we're looking at this thing. But we did break out. We had the highest close we've had since going back to June 17th. Volume was also higher. So again, you might look at today's high as a trigger, but certainly reasonable. I'll just kind of look at this as kind of an inverted head and shoulders, and I'll just kind of measure this from the shoulder to the head. It certainly seems reasonable to get to 160, maybe even back to $2. So again, over 20% near-term upside. Plus, and also we're not totally tied to the United States as well. Finally, we're going to look at FANG. This is one that has had some bullish option activity in the past. None really in today, for example. We had the gap. We held it. We're breaking out today to a new high. For FANG, we're looking at probably getting back to 160 again. If we draw our fib retracement, you'll notice we're sitting at the 61% projection at resistance. If we can take out today's high, we're probably looking at this thing going back to the prior high at around 160 again. So again, some stocks to consider at the moment. Another one here, we'll look at gold. Now, gold was kind of a disappointment last week. Why? The Fed, Powell in his statement on Friday was fairly hawkish. And again, we're going to slay the inflation monster. We're going to keep stuff higher for longer. I mean, this was not what the market wanted to hear. Dollar strengthened as a result. We're back at support again. And it looked like gold was positioned or posturing to maybe make a little short-term run back to 1800, 1820 again. That broke apart on Friday. Now today we sold off. We rallied. We finished here about the open of the session. We saw bullish activity last week in Newmont, NEM, gold, Barrick Gold, GOLD, KGC, for example, on Thursday, FCX, which isn't a pure just miner, but it's pure gold miner. But again, a lot of commodity strength on Wednesday and Friday of last week. But today it's Goldfield's turn. So we look at GFI. Go to the trade tab. We're looking at October here at the $9 strike price. So let's come down, look at the statistics. 9 times the average, 42% at the ask. So we're definitely seeing what? Buying interest coming in today in GFI. Similar dynamics last week. 1,000 contracts traded in one print at 45 cents. You see all this other activity kind of filtering in here. So point being is that there's buying activity, mostly buy side activity and calls on the 21 October 22 $9 strike price. Now, $9 isn't exactly way out of the money here, right? But if we can break above $9, that could create a little bit of gamma that could drive the stock here. We're looking at potentially at around $10. But remember, and when I say this, I always provide this caveat anytime I talk bullishly towards gold. Gold needs the dollar to go down. Market selling off is not going to yield that, generally speaking. So just watch. If the broader market sells off, the dollar strengthens, gold is likely going to go down. It may outperform the S&P. If we look today, gold's flat on the session. The S&P is down 0.66%. Gold should outperform, but in absolute terms, it may not necessarily go higher. So again, it's one of those things where it's kind of a two-edged sword, but a little bit of bullish activity rotating in. Another interesting one is with regards to SOXL. This is a leveraged ETF. I think last Monday we looked at VIXY and I talked about, hey, it's risky with these companies. They don't always track what you hope. And certainly VIXY didn't do that. Use it as a sentiment indicator. Same can be true for a double leveraged fund like this, for example, right? If you're a 3 times leveraged fund like this. So they can have tracking errors because of the daily resetting. But it can be an indication of sentiment in these types of, in semiconductors, for example. But today, 4 days, just huge activity. No real big prints coming in for 10,000 contracts in one. Didn't exactly roll like that. Again, probably some just trade in that, the options on it. Even though there's not really much of an advantage here, but again, it's like this, 2nd September 17 and 18 here. Again, going back in here. So 17's out here, right? So at that strike, not a tremendous amount of really high prints, but again, it's one that can make movement. But the market's got a bottom here. Now, take another semiconductor stock, in this case, not a fund. Again, that's probably speculating for a major market rally on semiconductors coming off the highs, finished near the lows of the session today. And this doesn't have an immediate impact because it's out there a ways. You don't have the gamma, meaning the delta changed quickly. There was some put option buying out here at the 45 strike for January. So just kind of showing the possibility that, something on may end up rolling lower in the coming months, looking for this to be 45 or below by expiration. And so again, I just want to throw this one out as a bearish opportunity. Just playing the downside here is maybe it starts to play catch up with the broader semiconductor space. And it's probably what we're looking at here is SMH finishes near session lows, down nearly 2%. So again, be careful. I'm just showing the SOXL. I think this is largely speculative type interest, hoping that if they can catch it. Now, the thing you have to realize is there's no extra leverage buying a call on SOXL. Okay, it's gonna be the same as if you bought SBOT or sold SMH, in that they're correlated. But anyway. But it can be used as a sentiment indicator. All right, so we'll kind of wrap it up there. As you look at the top performing stocks over here, a lot of them utilities, EXC, energy in here as well. So I expect that trend to continue, especially if we catch a little bit of a near-term rally, but hopefully would outperform if we do slump a little bit further. But we may reach those that signal this week where we find a little bit of near-term bullishness setting up from the volatility markets. Again, the 3-month VIX trading below the VIX, VIX in backwardation, that kind of stuff. VIX popping a little bit. So we may have more pain. But if we do rally, remember, this is likely what? Temporary. We've yet to really clear out the sellers. It may take a while to be able to do that, but we'll probably end up kind of meandering here for a little while if we don't sell off hard. So again, the bullish case scenario is to see more of a harder sell-off and then getting an opportunity to sell premium. And one of the things we have at at TheoTrade, Don has his inflection point spread. It's an ultimate strategy. He added some inventory on last week into the selling, which is good. And he's going to add further in terms of selling premium into further selling if we get it, if the VIX starts to go higher. So if you have an interest in the idea of selling premium in high probability strategies, for example, he sold a 4,600, 4,700, or 460, 470 up here. This pullback allowed him to close it out and enhance the profits off of this rally, selling a put and selling a strangle down here, adding calls to it up at these levels. And so if you have if you want to play volatility and stop playing direction, encourage you to look at the ultimate and inflection point strategy. So that can be a huge plus for you right now, rather than always have to take a stand on direction, play time decay, right? Hedge your downside risk. All right, with that in mind, we'll kind of wrap things up in the video today. We'll see you back next week. Thank you.